wealthbranch.com.
3 mental stock filters for investors. When analyzing companies, these 3 filters may help you save time. Your circle of competence, the too complicated pile, and a research watch list. 1. Circle of competence. If you can't understand the balance sheet, you probably shouldn't own it. Peter Lynch. The primary goal of having a circle of competence is to only buy what you understand. If you were laying out your life savings to buy a private business, you probably wouldn't buy the most complex business you can find, especially if you knew nothing about the industry. However, people tend to do this quite often in public markets. Are the company's financials in your circle of competence? If you don't fully understand a company balance sheet or how the company generates revenue, it may be wise to put the company in your too complicated pile and forget about it. If you have the potential to understand the company, but you need to do more research, put the company on your needs more research watch list. Your circle of competence can also act as a filter to help you focus. Because it's very overwhelming to analyze multiple companies, the circle of competence also acts as a filter to help you focus. Don't worry about a small circle of competence, because after you've defined your circle of competence, you can always work diligently to expand it and source new deals. 2. The too complicated pile. I don't look to jump over 7-foot bars. I look around for 1-foot bars that I can step over. Warren Buffett. Your time is valuable. Why waste it trying to understand a murky company and complex industry? If you find yourself doing this, delete the ticker from your watch list and then search for a more straightforward investment, or like Buffett says, look around for 1-foot hurdles. It may be tempting to invest in companies we don't understand, but resist the temptation. Here's an example of someone asking if they should invest in Deutsche Bank, and a paraphrased answer they get back from a fellow investor. For 5 years now, I get almost a message per week asking me whether this stock is cheap. I keep telling people how impossible it is to value such an entity. It all usually falls to deaf ears. It has too many moving and hidden parts. Good luck. For example, the declared core capital of DB is 54 billion euros, which is 1.8% of its active positions. Credit losses of 2% would wipe out DB. I expect there will be 20% of credit losses during a typical crisis, not to speak of their derivatives business of 44 trillion euros. Here, 0.1% of losses wipe out DB. But during a real crisis, there won't just be some losses. The counterparties of these trades will disappear altogether. DB is a sleeping landmine. I put it in my too difficult to understand pile and move on. There are so many other banks that offer better odds. If you don't understand or cannot verify what this investor is talking about, you probably do not want to be on the other side of traders who can. Resist the urge to engage with complicated businesses when you can make lots of money from simple ones. Here's an example of when Peter Lynch made 10 times investing in Dunkin' Donuts.
I owned Dunkin' Donuts for 12 years. I think I might have talked to him once every year. The story didn't change a lot. You don't have to worry about low-cost imports coming from Korea when you own a donut company. You don't have to worry about the economy. You don't have to worry about somebody inventing a new computer chip. The story doesn't change that much.
Research watch list. The research list is pretty self-explanatory. Maybe you're researching a company and are on the fence about it. You don't fully understand the company, but with some more research, you believe you could. For these possible investments, just put them on your more research watch list.